Hello, my name is Doug Pless. I am a full-time trader and a SpotGamma content contributor. This presentation is a case study that shows how to use a variety of SpotGamma tools to find and plan a trade. The instrument selected for this case study is the ES futures contract, showing an intraday trade on December 10th. I have a two-step process for trading. The first step is planning. I use positional analysis. I look at how traders and market makers are positioned in the options market and how those positions change from day to day to develop a thesis regarding the expected trading range and volatility for the day, as well as a directional bias. The second step in my process is execution. I watch how price reacts at key gamma levels, real-time order flow, and real-time market maker hedging flow to confirm my thesis and for setups. Let's look at how I use this process to get from planning to execution for a trade in ES. The setup that I will cover is based on the positional analysis of SPX and SPY, the underlying index instruments. This setup can be taken with ES futures contracts, SPY shares, or SPX and SPY options. Position duration or time frame could be intraday or longer. For this case study, my instrument is ES and my approach is intraday. Here's the agenda for this presentation. First, I will go over a brief overview of the ES contract. Next, I will cover my planning process, how I use SpotGamma tools for positional analysis and develop a thesis. Next, I will discuss trade execution for the case study. I will briefly go over alternative trades. Finally, I will review the key takeaways for the case study. I'm sure everyone is familiar with the ES futures contract, the E-mini. It is a derivative of the S&P 500 index and trades 5 days per week and 23 hours per day. The Standard & Poor's 500 S&P 500 includes 500 leading companies and covers approximately 80% of the U.S. equity market's available market cap. SPX is the ticker symbol for the index, and SPY is the ETF version of the index. When traders buy and sell puts and calls in SPX and SPY, market makers take the opposite side of the trades and hedge their delta exposure with ES futures contracts. For pre-trade planning, I look at the following data. First, I look at the SpotGamma key daily levels and how they changed from day to day. Are traders looking for, accepting, and positioning themselves for lower or higher prices? For example, if both the put wall and call wall move higher, this indicates traders are looking for, accepting, and positioning themselves for higher prices. I also look at trace heat maps. I start with gamma before the open to see how market makers are positioned. After the open, I watch delta pressure for areas of buying support and selling pressure. Finally, I look at charm pressure mid-morning to identify potential pinning levels at the close. I also look at the HIRO indicator, which is part of my execution process. Before moving on to my planning process for this case study, let's briefly look at some background information and explanations of these levels and charts used in the study. The key daily levels and other metrics are available on the dashboard home screen in the data table at the bottom of the Founder's Notes in an Equity Hub. They are updated every day. They are proprietary to SpotGamma. The absolute gamma strike is the strike with largest absolute positive and negative gamma. The volatility trigger is SpotGamma's proprietary gamma flip level, with positive gamma above and negative gamma below. In a positive gamma environment, market makers have to trade against price to hedge the delta exposure. This tends to subdue or decrease volatility. In a negative gamma environment, market makers have to trade with price to hedge their delta exposure. This tends to enhance or increase volatility. The call wall is the strike with the largest net positive gamma. It can act as resistance, since market makers will most likely have to increase delta hedging at this level. The put wall is the strike with the largest net negative gamma. It can act as support. The SpotGamma Gamma Index is a proprietary measurement of the total amount of gamma in the underlying index or ETF. It generally ranges from -4, that's high volatility, to 4, low volatility. Gamma notional is market maker's position on the gamma curve. A positive gamma position infers lower volatility. since market makers will need to trade against price to hedge delta exposure. A negative gamma position implies higher volatility, since market makers will need to trade with price to hedge delta exposure. For this trade, I use the trace heat maps. They are also proprietary to SpotGamma and updated every 10 minutes. The first trace chart I look at is gamma. The trace gamma heat map shows areas of positive and negative gamma. Blue zones indicate positive market maker gamma. Red zones indicate negative market maker gamma. Darker colors indicate stronger gamma. Traders should expect volatility in positive gamma, again that's the blue zones, and higher volatility in negative gamma, again that's the red zones. The trace charm pressure heat map shows how market maker hedging changes with respect to time. Charm is typically heavily influenced by large 0 TTE options volume. Charm pressure can lead to pinning near positive gamma nodes at the end of the day. The trace delta pressure heat map shows the net change in market maker delta positioning. In a positive gamma environment, blue zones indicate market maker buying support. Red zones indicate market maker selling pressure. Darker colors indicate stronger delta pressure. The SpotGamma HIRO indicator shows the market maker hedging impact of options trades. It is also proprietary to SpotGamma and is updated in real time. This chart is part of my execution process. Market maker hedging flow can have a significant impact on price. It is often a good confirmation of price direction. This chart shows the total signal for calls and puts for a combination of S&P 500 index components. That's SPX, SPY, XSP, and ES futures. The white line is SPX price. The purple line is the HIRO indicator. A rising purple line indicates traders are buying calls and or selling puts. A falling purple line indicates traders are buying puts and or selling calls. Let's move on to the positional analysis of SPX and SPY for this case study. These two tables summarize the SpotGamma key daily levels and metrics for SPX that were shown in the AM Founders Note and Equity Hub on Monday, December 9th and Tuesday, December 10th. Red numbers on the right indicate the value decreased from the previous day. The table on the right shows the volatility trigger and put wall move lower from the previous trading day. The SpotGamma, Gamma Index, and Gamma Notional also decreased. These two tables summarize the SpotGamma key daily levels and metrics for SPY that were shown in the AM Founders Note and Equity Hub on Monday, December 9th and Tuesday, December 10th. Again, red numbers on the right indicate the value decreased from the previous day. The table on the right shows the absolute gamma strike, volatility trigger, and put wall move lower from the previous trading day. The SpotGamma, Gamma Index, and Gamma Notional also decreased. The Equity Hub history, shown here, displays the changes in key daily levels and other metrics for the last 10 days. The history for SPX showed a move lower in the volatility trigger and put wall on December 10th. Note this screenshot was taken on December 11th. The history for SPY showed a move lower in the absolute gamma strike, volatility trigger, and put wall on December 10th. Note this screenshot was also taken on December 11th. The trace gamma heat map at the open at 9:30 a.m. Eastern Time showed positive gamma notional, that's a blue shading, from just below the 6025 put wall up to the 6100 call wall. Positive market maker gamma notional is indicative of lower expected volatility. There were pockets of negative market maker gamma notional, that's a red shading, below the put wall and above the call wall. Negative market maker gamma notional is indicative of higher expected volatility. The highest positive gamma was at 60.55. That's the largest blue bar on the left side. That was the short call strike of the JP Morgan fund, that's JHEQX collar, that expired on December 31st. The stability index was moderate at 46%. Here's my thesis and plan for this case study. I was looking for moderate volatility based on the mildly positive SpotGamma Gamma Index for SPX, positive gamma shown on the trace gamma heat map, and the 46% stability index shown in the trace gamma heat map at 9:30 a.m. I had a bearish directional bias based on the shifts lower in the SPX volatility trigger and put wall, and SPY absolute gamma strike, volatility trigger and put wall. I plan to watch HIRO and trace heat maps in the first 15 to 30 minutes for market maker hedging flow and to see how market makers were positioned and how those positions were changing. I was looking for SPX to remain in the positive gamma zone between the 6025 put wall and the 6100 call wall, shown on the trace gamma heat map. If SPX broke below 6020 or above 6100, I expected faster movement in the negative gamma than the red zones below and above these strikes. On Tuesday, December 10th, SPX gapped up and opened at 6057.59. After the open, SPX oscillated up and down around the 6055. Large positive gamma strike is shown on the trace delta pressure heat map. SPX reversed lower after moving into the red selling pressure above 6055 just before 11 a.m. and again after 12:30 p.m. On the second reversal at 12:30, SPX made a lower high. This is the S&P 500 index HIRO signal showing total call and put trades for SPX, SPY, XSP, and ES futures. At 12:35 p.m., a flow alert signals significant options activity and a potential reversal in hedging flow from positive to negative delta. The alert is shown on the S&P 500 HIRO chart with label 1. At 12:52 p.m., traders began buying SPX, SPY, and ES puts and selling calls, noted with label 3 on the HIRO chart. Market makers were taking the opposite side of the trades, selling puts and buying calls. Since market makers want to remain delta neutral, they had to sell ES futures to hedge their delta exposure. Traders continued to buy puts and sell calls until around 3:30 p.m. The bookmap chart shows that ES reversed lower at the SPY 605 absolute gamma strike, that's around ES 6068.25, just after 12:30 p.m. Eastern Time, that's label 2 on the chart. ES continued to move lower as traders bought puts and sold calls. Market makers sold ES futures to hedge their delta exposure, and aggressive traders fueled the move lower. ES continued to drop until finding support at the ES lower daily expected move, that's LDEM, that's the third label 7 on the chart, just after 3:30 p.m. There were several opportunities to enter short positions on pullbacks. Potential entries are shown on the bookmap chart with label 4. Charm pressure shows how market maker hedging changes with respect to time. Charm is typically heavily influenced by large 0 DTE options volumes. Charm pressure can lead to pinning near positive gamma nodes. The first charm pressure heat map at 11 a.m. shows 2 potential pin targets early in the day, one at the 6055 large positive gamma strike and the other at 6035. The 2 pin targets were between blue buying support below and red selling pressure zones above at those strikes, shown on the right side of the chart. The next charm pressure heat map at 1 p.m. shows the positive gamma building at 6035 as SPX continued to move lower. If SPX continued to grind lower and broke below the 6045 volatility trigger, 6035 was the most likely pin target. SPX tested the 6045 volatility trigger several times and broke below that level around 2:50 p.m. Eastern Time and traded lower down to the 6035 pin target. SPX closed at 6034.91, right between the red selling pressure zone above and blue buying support zone below, shown in the final charm pressure heat map at 4 p.m. See the yellow arrows. There were several ways to play the move lower, including shorting SPY shares, buying put spreads, selling call spreads, or buying a butterfly centered at the final pinning target at 6035. In this case study, the trade was short ES futures with a final target at SPX 6035 or ES 6045. Here are the key takeaways for this case study. First, the red selling pressure zone on the trace delta pressure heat map confirmed the reversal lower around 12:30 p.m. Eastern Time. A HIRO flow alert at 12:35 p.m. signals significant options activity and a potential reversal in hedging flow from positive to negative delta. HIRO confirmed the move lower, showing traders were buying S&P 500 index puts and selling calls. Finally, the trace charm pressure heat map identified two potential pin targets at 60.55 and 60.35 early in the day, providing plenty of time to take a position for a move to one of those levels. That wraps up this case study. Thank you very much for watching.